Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Welcome back, everyone, to the 102nd episode of Punch Card Investing. Happy to have everyone here and happy to have Patrick with us again. Patrick, you gave me a pretty good idea for this episode, which was going over your watch list, or at least a few of the stocks on your watch list. I think a couple of these you own, you said. We'll just be kind of going through a handful of those and seeing what there might be to like or not like, and kind of talk through some of these ideas. I know the people love ideas, so we're trying to stick with that theme as much as we can and see what we can find here. But in the meantime, before we get into that, please, everyone, be sure to subscribe if you haven't already so you don't miss out on future episodes. We try to put out a new episode every week or two as we move forward here, but we also have some additional content that we're now putting out in the middle of the week, most weeks. We have our two series that have recently started. That's Contrarian Corner with Mike Sharp and Firm Discussions with our friend James with Firm Returns. So please check those out if you haven't already. They've been pretty well received at this point, so that's great. And we're going to continue pushing out more of those sorts of series in the future as well, and try to mix in some new ones too beyond just those two. So thanks everyone for your support as we move through some of these channel changes, and think the future is bright for the punch card community. So thanks again, everyone. And like I said, if you haven't subscribed already, I don't know what you're waiting for. So please do that. And check out all the great stuff in the description below as well, including a link to Patrick's channel. Now, Patrick, where were we? How are you?
Well, I'm great. I'm excited to do this. I think I'm going to benefit from it. I think it's really good to just have somebody to talk to about the investment ideas. It helps you also understand it more if you try to explain it to somebody else. And then hoping to get some feedback in the comments too. That's welcome, even if this is a terrible idea.
Well, ideally it'll be a little more constructive than that, but
yeah. I don't know. Yeah, that's what Warren said. Charlie would tell him that he's like, I knew I had something as long as Charlie didn't say that might be the worst idea I've ever heard in my entire life. So
we'll try to be a little less brutal than that, but
yeah. So I guess I tried to pick. These are so two of them are very small positions for me that I've considered adding to, and then the rest of them are watch list items that just have intrigued me, so that I haven't pulled the trigger on. Some of them I've been watching for a year. So, but yeah, we'll talk about that.
Is there one you want to start with? We can just get into it.
Yeah. Let's start with RYAM. That's Rayonier Advanced Materials. They are a chemical company a chemical manufacturer, specializes in cellulose-based products. I originally started watching them at during COVID, like in 2020, whenever lumber prices were, super high, and they had a lumber mill at the time. They wound up selling that, and I've just been watching them since then. Basically, they're a spin-off company from their parent company, which is just plain Rayonier, not Rayonier Advanced Materials, and they got stuck with all the debt on the spin-off. So it's not a great situation as far as like the debt, the balance sheet goes, and that's why I've kind of hesitated, or that's why it's one that's a small position for me. So, but I think that current management really understands the problem with the debt, and that they're taking steps in that direction to pay down debt. They've already done that, and they're very focused on free cash flow and all of that. I mean, right now, you're showing a bunch of red numbers, but they're they're estimating, I think, let's say $50 million in of free cash flow for a kind of a trough period, and the market cap's 200 million.
Yeah, I see
So
that.
so you're getting, a 25% yield on equity. Now the catch is once you start looking at it in a on an enterprise value basis, now you have to, even if you're doing like, let's say EBITDA minus capex over the enterprise value, the debt's just so much that it starts to get a little scary. But
We can get into the debt in a moment, but I have to say this very much sounds like a Patrick stock. Anything with materials, industrials, that's just right.
yeah,
There's a new
I've
week.
yeah, I've done good on real products.
Yeah,
It's the
you
tech
mentioned
stuff.
you mentioned it's a spinoff, but I see the company says it was founded in 1926, or is that the parent company?
Yeah, it was combined with the other one, and
I
I
see.
think, yeah, it's got the same name as the parent, but it just has advanced materials,
Sure,
after it.
got it. Okay, so now let's get back to that debt. So yeah, it's 4 times free cash flow approximately, depending on where that free cash flow stays. But what's the debt service looking like? What are the debt terms? Is it coming due soon? Is it variable
So
rate
they
debts? What are we looking at?
Yeah, so they actually just refinanced a portion of it and paid down a lot of debt as well. I can share my screen, but let's see. I'll share it real quick.
I'm looking at long-term debt. Yeah, about 750 million in long-term
Mhm.
debt, and that's against about 150 million in cash, at least according to their most recent report.
Mhm. Yeah, like I said, it's a lot more debt than I'm used to at all. The exception for me here is that it's new management, and that that's like the number one priority for them is pay that debt down, and that it's not going to be coming due for a while. So basically, they had two big chunks coming up. One was in 2024, one was in 2026. Um, they they had 318 million roughly due in 2024 here. But what they did is they took $85 million in cash and then paid that off and then borrowed another 250 that's not going to be due until 2027. So, as bad as debt is, or like, it's, as long as they're generating enough cash to continuously pay it down and stuff, that does give me, some hope. And especially if you look at their guidance for, and I'll pull that up. They're guiding into, that's not what I want. They're guiding into a trough period of earnings, and let's see, yeah, press release. Here you go. So I love this. Okay, and the stock. So I put out a video on them whenever there was something like $4 a share, $4.50 or something like that. They released this earnings report where they say, hey, we're gonna reduce. It says updates, but they reduced their EBITDA guidance and increased free cash flow. And I was like, that sounds great to me. It's so
What's not
anyway,
to
the
love?
stock dropped a like on that news. Like if I can go back to the it's been in the last month or so. This is where it dropped. I had done the video, of course, like right before this drop. So apologize to anybody who watched that and bought it. But I didn't recommend it at the time. I said it was going to be a something that I was watching for a big move because I thought their earnings were going to be very volatile, and they were, and it dropped
What
from
what were people most
425.
offended by? Is there
Huh?
a consensus? What were they most
It was
offended by?
the lowered guidance in general.
Okay,
So,
it was just that. It wasn't some other things
so
too. Okay.
yeah, that's stocks dropping is that's what I see the most of is, it's the
Yeah, it's usually
guidance,
guidance.
which is crazy because it's like the next year guidance, and it's like, man, you have a lot more years after next year, and we're going to get to that
Yeah.
whenever we get to Mastercraft. But like, adjusted free cash flow, I told you 50, but they're saying 55 to 70, so I went even lower than that. So in a down period, you're talking about a free cash flow, like I said, free cash flow yield of 25%, which is interesting. And another thing I like about them, let's see if I can pull up their.
I guess the question that comes to mind is how much have they ever gone below that in recent years? Below the $50 million, and also what's the adjusted free cash flow? What is that? What does that actually mean?
That's a great question. Let's see. That's why when they said adjusted from 55 to 70, I think that's why I say 50.
I see.
Adjusted usually never lower, if that makes sense.
Oh, of course.
It's always
it otherwise.
Looking for their capital. Oh no, this is financial supplement. I was looking for their capital allocation, but I know I'm jumping around, but we'll go look at their free cash flow, and of course they went up 5% today. I was thinking about buying more after, but I wanted to talk to you first and see what people thought. So annual basis cash flow statement, you just look at free cash flow per share, or we can look at total free cash flow, but I wouldn't really look at anything past 2019 though.
What does it say? It's a little small.
Oh, it's
you zoom in a little bit, maybe. Yeah. Whoa. There we go.
Yeah, it's this row right here.
Free cash flow per share.
So, I mean, it's right at $3 a share right now, and you're making $1.30 a share. It's crazy. But like I said, the danger is that you start to go is that the down cycle. I've always said the worst business to have a lot of debt in is a cyclical commodity business, and that's what it is. But I just think that the market's overreacted a little bit to that, if that makes sense.
I see that's quite a few negative months. Is that investing into just like big CapEx things during that time? So it looks like it's gone negative for this is
years.
Yeah, out of the last, but it's had negative free cash flow per share in multiple of the last few years, right? If I was looking at that right.
It was the
so negative. What is that? Last year?
Yeah,
and 4 years ago, 5 years ago.
Yeah, in 2019, their business changed a lot because since about this time they sold their lumber mill. They paid off a lot of debt, and like if you thought it was a lot of debt now, like if I go back to the balance sheet and show you what it was, even. So let's see, look at total debt down here at long-term debt. Like it's $750 now, which is not great, but it was over $1 billion before,
Yeah.
So
okay.
Yeah.
So they were selling off. It sounds
they
like
did sell they sold some assets, but then they also their capital allocation plan is like, look, priority one, we're getting out of the debt hole, and
okay. And I mean, they do have $150 million in cash, and as long as the stuff can do that soon, like we were kind of discussing, then they have somewhat of a runway. But if there's a major downturn, they have big losses that could be a bit troublesome.
Mm-hmm. And that's their CEO on their recent earnings call. He really talked about their flexibility to cut cost in the downturn, and that's kind of where that free cash flow comes from. And this is another negative.
Which costs then? Why not cut them now?
Is it deferred maintenance and stuff like that? That you're gonna have to pay for eventually. One of the analysts like straight up asked him that, and he's like claimed it was just costs that were going towards value added growth projects and stuff. So we'll see. My experience is there's usually a lot of costs that can be cut in stuff like that.
Sure. Okay. Yeah, I was just wondering why not cut now if you're that worried about the debt pile.
Oh no, they're cutting now. That's what that's why the free cash flow went up. Their estimate.
See. Why?
Because they're cutting capital expenditures pretty much.
Okay. You probably won't see growth, but
I don't want any growth. I want nothing.
Yeah, if they can maintain. Okay.
And like, if you look at somebody like my least favorite debt companies are the ones who are just comfortable being in that much debt. Like, I think of somebody like AT&T,
Yeah, the big
these companies
telecom is what I was thinking too. Yeah.
that they pay a dividend instead of paying down their 7% notes or so. It's great, and their leverage 8 times.
Yep.
That's what's crazy to me. If somebody has a plan and okay, last thing. Can you go to Open Insider and pull up their ticker? This is kind of the icing on the cake.
Right. There you go.
Yeah. Look at all that green. So a lot of purchases, and like significant purchases, increasing stakes by 60%, 20%, all in like the $4 range, So
all after May. Yeah. Is that right
Mhm.
Is that right after that earnings? When it fell a bunch?
No, the earnings just came out.
That was
That was
very recent.
okay. So May they had earnings and it dropped.
So they bought after those. Okay.
They bought after that, and they didn't buy after this dip, which who knows, but at least
no
they didn't
sales.
sell either. So
yeah, right. No sales. All pretty hefty.
And the CEO is relatively new. They had somebody in there previously who you could argue wasn't doing a great job. I mean, to get in that debt situation,
Well, yeah.
But it was also part of the spinoff. So
okay.
Yep.
So then I guess what's the big upside? It's low multiple now. Call it 4x free cash flow with some asterisks in there. Let's say they get the debt down to a more manageable level, or kick it out further and get that pressure off. Well, they haven't been at that point though. They haven't been reinvesting into growth because they've been reinvesting into debt pay down. So,
I mean,
is it just simple multiple expansion? And once they get a little bit of that debt pressure off,
it's multiple expansion, but also the interest goes away,
Mm-hmm.
and this multiple is based on the trough earnings. So, if earnings go up and you're leveraged, it's like
well,
it could
well,
be
you say the trough earnings, but they have had negative quarters. I understand that was partly with capex reinvestment, but or negative years, I should say.
With $200 million extra debt,
yeah, that's what I'd be most worried about. Is just like
it continuing to go low and being negative.
One negative year, and all of a sudden it's like, oh, you undo the progress in the last 3, or if they're in the middle of this and they're not growing otherwise, unless they have some internal growth route somewhere that I just don't understand because I'm not familiar with the industry.
I'm sure they say that they have it. It's not part of my thesis though. Like, I'm not banking on that, if that makes sense.
Yeah. I wouldn't know either way for that industry.
I also don't like that one of their operations is in France and just Europe in general, but wish it was all United States.
Why is it a big portion of it?
I would say it's like 1/3 maybe.
Oh, so that's pretty serious then.
Or it's like one of their big, maybe I'd have to go look at the exact numbers, but it's it's one of their big plants is in France.
I see. Okay. Oh yeah, that's an added wrinkle. Who are their customers exactly? Who are they selling to?
It's specialty cellulose products. So it's going into it's pretty much like a building block for people who manufacture things that use that. I know somebody told me that it used to work for them, that it went into one of the things they made, like went into glasses or something like that.
Oh, here we go. Yeah, such as liquid liquid crystal displays, impact-resistant plastics, thickeners for food products. That's quite the mix. Pharmaceuticals, cosmetics,
Yeah.
cigarette filters,
There we go.
rayon yarn for tires and industrial hoses, food casings, paints, and lacquers. It's a bunch of random stuff.
Hey, we got a lot of screens now. So liquid crystal display. That's LCD, right? That's the
Oh, I guess so. I didn't even know
Yeah.
that's what LCD meant. You
So
learn something new every day. Okay.
I was just complaining about all the screens in this new car I was driving. It's like driving a spaceship now. You know, every
You got a new
is
car?
bad. No, I don't have it. I was driving somebody else's. I felt like I
get the
needed
new
to watch
whip?
a tutorial before driving it.
All right. Well, it seems like a classic sort of value play, but with some obvious downside risk. You know, you're
hmm
it's a contrarian bet just because of where the momentum is and where the company fundamentals are, and you're betting against the crowd that this will go pretty well with the debt pay down, and you'll eventually have some multiple
hmm
re-expansion.
And
Not just a tiny bit of growth on top of that, but like you said, if they're getting rid of interest expenses, that should grow cash flow too.
hmm
So it's not
and
all lost.
yeah, and one way that I've kind of, I guess, protected myself against it is just to make it a smaller position, because the downside here really could be zero. And I feel like a lot of the other stocks I own, the downside's protected by a strong balance sheet. So it doesn't have that risk, you know. So
Sure, right.
that's why it'll probably stay under 10%, I would think.
Yeah, it's just there's some obvious risks just based on the balance sheet. So okay, well that's an interesting idea at least. Now what about should we just move on to another one? So we spent a good about 20 minutes.
Yeah,
on that.
we spent a while. So Mastercraft, let's talk about Mastercraft. This one
Okay.
is one I'm worried I made a mistake here. I'm gonna share my screen.
So this is another one that you hold?
Yeah, it's been a just a little while. Yeah, I did a video on them. I started a small position. I'm gonna tell y'all, anybody, if you want a great strategy for investing, what you should do is you should watch my videos and just short for like 2 weeks, and then I swear they'll go down big after 2 weeks, but then they eventually come back. So it's
swing trade your videos.
Swing trade, like sell whatever I say at the beginning. But then
always too early. Always too early.
Yeah. So I want to say I bought originally around 28, 27. And once again, they announced earnings and guided very low. And people sold it off crazy.
I guess just for some context, here's the ticker description of it. We got Mastercraft Boat Holdings, through its subsidiaries, design, manufactures, and markets recreational power boats. It operates through 4 segments: Mastercraft, Crest, Nautic Star, and Aviera. The Mastercraft segment produces recreational sport boats used for water skiing, wakeboarding, wake surfing.
Mm-hmm. They make
boating.
boats.
Yeah, it's just boat stuff.
Which I'm a little worried. Well, I feel like I can understand boats, but it's also not.
I wonder if I'd love to get Tom's thoughts on boats, because I know he's an RV guy, and I'd be curious what he'd think here. But
well,
okay.
And the big thing here is, okay, first of all, it's a magic formula, so that is what originally got me turned on, and it was a magic formula at 30 plus, you know.
And it's at 21 now.
Yeah, it's at 21. So if something's the magic formula stock, you know it's going to have a great balance sheet, high return on assets, and be selling at a reasonably low multiple, right? So
based on recent earnings.
Yeah, based on recent. I have that note here. Yeah.
Yeah.
And they have announced a $50 million buyback program, which, look at what that's going to, on a market cap of 350,
right?
That's the seventh. That's
How
very
big?
attractive.
How long are they going to be doing that buyback for? Just in the next year?
I hope in the next year, but it could go longer. They had to launch they say they launched a new 50 million. You see the pun there with the boat, but they launched a new $50 million buyback because they ran out of their other 50 too soon. So they're buying back a lot of shares. Again, I think it's one of these things where people are freaking out about the sales moving. Like, they guided lower for 1 year, and if you look, I'm going to pull up their free cash flow per share for the last few years. Let's see. Can you see this?
Yeah, so we got $5.90 a share. In the last year, $3.31, $2.30, 85, or 85 cents, that is. $2.20, $2.30. So cash flow positive.
Yes. So imagine, okay, yeah, we have one bad year at 85 cents. You come out of that, you have way less shares, even if you're making, $3. They're not getting back to this. This was that COVID boom and all that. That's,
What
they might get back to that
was it though?
eventually.
That's 2023 now, isn't it? Is it like back orders from
Yeah,
2020 or something?
yes.
It worked for 3 years.
So it's the quarter ending June 2023. So it was really like so it was really 2022 in a way, so
Yeah, okay. Sure.
and it's I think I've shown on my like DCF calculator that if you can have 2 bad years in a row, as long as you're not really losing money, and then if you get back to like a reasonable free cash flow number, it becomes very attractive.
Yeah, it makes up for it. Well, so long as it gets there quickly enough.
Yeah.
Okay, so then what's the deal then? So we got pretty solid free cash flow yield. What is that? So at least recently, if they were to maintain the almost
They're not going to maintain that.
yeah, if they were to though, then you're looking at like a under 4.
Yeah, again, it's about the same as the last one. I
but
think
if it recedes down to what, like 2 a share? Well, what's kind of the thought?
My their guidance, I want to say, was, I'll pull it up actually and show you. I'm usually not a big guidance person. I like to look at the charts and do something a little more conservative than whatever they say. But
here's our adjusted guidance.
Yeah.
adjusted guidance.
Yeah, earnings per share, let's say $1.50, which let's just say that translates to free cash flow for simplicity.
Sure, it's all an estimate, anyways.
Sorry, I'm still getting over the cold from.
That was from a couple weeks ago, wasn't it?
Yeah, no, it's been put to the test since we started daycare with the baby.
Gotcha.
Oh, let me stop sharing for a second. Then I'm gonna pull up my my DCF thing.
I've got $1.50 a share on the current share price. Be about a 7% free cash flow yield. So not the most impressive, but not horrible, that's for sure. And if there's any growth after that, or if they have a couple of big years like you're kind of suggesting, then so long as they don't go negative, then I could see where you're coming from.
How is this showing up on the screen?
Let's see. Yeah, it looks good.
Okay, so this is what I use. Kind of like I just kind of estimate a few years, and then it'll kind of discount. So I don't know. I'll put 15%. Be super.
15% discount rate.
Super harsh. And then we're gonna go $1.50. I'm sorry, $1.50. let's see, $2, $2.50, and then they're back to the 3, let's say.
Okay, that'd be pretty strong.
And then you think that's, I mean, they were at $6 a share, but before.
Oh yeah.
I think this is pretty conservative but I mean, maybe not.
What if year 2 is what if they're $1.50 for like 3 years in a row? Okay,
terminal
still
value
not
is
bad.
$23. So, and that's at a 15% discount rate. So
Yeah.
you can use a 15% and then not put as big a margin of safety, or you can use 12.5. And now you're up to $32. But I think what I found out once I did the guidance is that I probably paid too much at the 27, 28. Or
Sure.
how about this? I probably didn't do a margin of safety. So now does that exist now at 20 though? That's
Yeah.
kind of the
What if
question.
it's what if they have like a 0 year just mixed in there? Like let's just say year 2 it's 0 because we have some bad downturn, but then they recover after that. Still not bad. So
I
long
think
as they
with the DCF, I think that this is what really illustrates one year. What really matters is what the business is going to do for the next, really until this line starts leveling out for
right.
the next 10 to 20 years. But before that, it's
how long do you run it for? So it's like 100 year.
Yeah, I mean it's 100 years, but it's pretty much stopped counting by.
Yeah, it doesn't really matter
discount.
after that.
That's another reason why I do the high discount rate.
Sure.
Now you see here. Now it's if I do, it's not looking good like this either. But I mean, think about if they get back to, they're going to have less shares outstanding. So they could make the same sales, and if they retire 7% of the shares, or I'm sorry, no, they were going to 1/7, so 14% of the shares. That's a big difference, right? So you're looking at, let's say 3, divided by 0.86. That's just,
that would imply around fair value.
Yeah, but
with a 50%
this is
discount.
with these really harsh assumptions,
Yeah, assuming you have a not a bad year and then like a not great year, and then it kind of recovers. Which I hate to bring like macro into it, but I just picture like kind of the problems with some like RVs, and a lot of demand is pulled forward, as we're kind of saying with the 2020, we'll call it the 2020 era, those couple of years.
Yeah, that's what I'm worried. That's what I'm worried about. That, and I'll say the luxury goods has probably been my worst area.
Yeah,
by far in investing. Now it's also been, like I said, this is a very small position. Other luxury goods have also been small because I know that I was probably playing with fire. But I mean, between Smith and Wesson, Sleep Number, all of them. This one,
they've all been on a Magic Formula at some point.
Yes,
because Magic Formula loves those short-term big years because it's past looking. So can't say I'm surprised that it would make it on, because they had this great year, and then the price is depressed since then. Now,
yeah, that's I've kind of followed the Magic Formula for better and worse. Like it's made me, I've had some really big winners. I'm thinking of Atcore especially. But then like you said, I think it's caused some other ones to not to turn out as well.
Yeah, I mean that is investing in general. Like whether it's off that list or somewhere else, it's just like there's always a downside risk in any investment. It just seems like the downside for a lot of Magic Formula stocks might be more consistent than others, where you have like a big short-term year followed by some sort of regression, reversion to the mean, or something like that.
And think about, but let's say that you recognize that, and now you said, okay, I'm gonna look for Magic Formula stocks, but only consistent earnings. Maybe you protect against that.
Right. Yeah. Now, I guess what other have they had a losing year? Because we were looking at the free cash flow per share, and it looks like it's been quite strong for a while. Yeah, I'm looking at positive free cash flow.
The lowest was the 80 cents.
Yeah, it's been
83 cents.
positive since 2013, as far back as it goes on ticker. Here's the chart, which is kind of impressive. I'm curious how this would do in a proper bad recession, but man, it did great in the last year. I guess if it reverts down to if they have like 1 or 2 80-cent years, but if it was able to recover to kind of what it's done for many other years, then you have a decent shot there. Okay.
Especially if they're buying back shares,
Yeah, with the buybacks, and even if there's not a ton of growth.
Up.
Are they picturing to have a decent amount of growth, or 350 million? But I don't know what the luxury boat toy market is.
They say that they're having growth, but I mean, like I said, I don't like to factor in high growth rates into my calcs because
total recreational boat market value. Let's see if there's any estimate. I'm seeing a number 17 billion was the U.S. recreational boat market in 2022. That's a big year, probably, though. But then I'm seeing another one that says the global recreational boat market is 19 billion. So it's barely any bigger.
We have all the boats, yeah.
Yeah, the U.S. is all of them, all the boats. So I don't know. Call it 15 to 25 billion. So they could certainly carve out a bigger chunk of that. If that's like the upper limit is the entire recreational boat market. If they're able to get up to $1 billion, I don't know if that's or even through acquisition. It seems like they like to acquire segments. I'm not sure if that's in their forecast. Do they want to acquire more boat companies, or any talks of that? Probably not at the moment, but
I think that, if the price is right, but yeah, I don't know.
Anything in recent years, I wonder, like, they don't strike me as a serial acquirer, but it seems like they've made some acquisitions just based on how they're organized.
Yeah, so they own a pontoon boat company, I think called Crest, and then they own kind of a fishing boat company, and then they have
4 segments.
They have the sports boat.
Let's see here. Long-term debt, 50 million, so not crazy at all. Cash.
Oh yeah, that's so that they have no debt, and their cash, they put all their cash into corporate bonds.
Yeah, so
and they're making like 7 or 8% on that. I think I did the math. So it's like
save about 100 million or 110 million in cash and short-term bonds.
Like their interest, it's like the opposite of RIM, right? They're actually making money on their income statement. If you look at the interest, it's a positive, not a negative. In recent quarters, that's what they used that boom that just happened. They bought back shares and then piled into a bunch of corporate debt, I think, or treasury securities.
Yeah. Okay, so not pretty clean balance sheet compared to the last one. So, yeah, okay.
Yeah, no, well, it's a magic formula. You're going to see that,
Yeah, true. Usually. All right, well, that's an interesting one. That one seems... I want to say it's more straightforward, but then again, it's like you're betting on like the luxury boat market.
What happens if people start, actually...
That's
realize
that's the first thing to go. Like if
exactly,
and you just had the big year, so you doubt you're gonna have another one very soon. At least that's my knee-jerk reaction. I could be totally wrong, but but that DCF you ran was kind of promising. It's like even if it has a couple bad years, I guess how bad could it get to where that DCF would still make sense?
Having no debt is the key.
I think so, because you can weather the storm. Yeah. They have a decent
Which
balance
again, like I
sheet,
said,
too.
it's like the opposite. It's one of these weird. It's the opposite of the first one we talked
Yeah.
about. We're like,
So everything has a balance, right? Okay. Well, then let's maybe we hit another one then.
yeah. So let's do one more.
All right. Sounds good.
I want to talk about figs. So this one's. I don't think I've gotten close to buying it yet. I've been watching it since the IPO because from the first time that I paid like $600 for one order of like my wife's scrubs.
Huh.
And I was like, I immediately Googled this company. I was like, who the hell is this?
Yeah.
Figs. How are they charging?
This sounds
So,
familiar.
so you know who they are or no?
My wife had to get scrubs as well when she was in audiology school. So I seem to remember the Figs name at some point. But
Yeah. So basically, they were the first to market. Remember, we talked about that on the moat section in the luxury scrubs, or like scrubs were these like frumpy, kind of worn out things, medical attire that everybody wore. And these two girls just decided, hey, what if we went like
high
direct
fashion,
to
right?
consumer and made them look nice and be out of a good material? And they did that, and it's like you have to have it, as far as at least that's what I was told. You have to. And it's funny, I went to like the first dinner I had with her other doctor friends. I was like, so what do y'all think about figs? Do y'all think it has a moat? And they're like, what are you talking about?
You forgot who you were with.
Yeah, I was like, well, are there any competitors? And they're like, yeah, figs is still kind of the number one, and what's crazy is
What do you mean a moat? What does that
yeah,
mean?
they have like a 70% gross margin. Okay, it was 75% whenever they IPO'd, but okay. So first of all, they're down 90% from the IPO because they IPO'd at a ridiculous PE that I don't know who would have. It was crazy. I looked them up, and I was like, this is a
It's because
great
I
company,
know
but
why.
it's
I know
huh?
why, because it was 2021. That's why.
Yeah. So
So they got
they
in
were
while
like
it
a
was good.
tech. Oh, the people were calling them the next Lululemon, and so
Yeah.
it was it anyway.
Wow.
So I've been watching them, and I've watched them fall from 50 to 5, and I haven't done anything. There've been short reports on them. Okay, so this is the craziness though, is that they have this huge gross margin, and then by the time it gets down to the income, or the bottom line, it's just disappeared into like stock-based compensation or bonuses or marketing, and you're like, what's going on?
Yeah, geez, that is a wild gross margin. What is is Lululemon, are they public? What are their
Yeah,
margins
yeah,
at?
yeah. Lulu,
Yeah,
I think.
yeah, they are.
LULU, yeah, I think.
Let me take a look real quick. So Lululemon's margins are, yeah, they're like 55% gross margins. So this is even higher by a substantial margin.
Oh yeah, I mean, I knew as soon as I paid for that first order, I was
You
like, "What
felt
the?"
that margin.
Yeah, I was just like, "I need to go look at this company." Yeah, and they weren't public whenever I first looked at them because that was back, I want to say like in 2020, but then they went public, and I was like, "Well, this is just a ridiculous
Well, their
valuation."
revenue continues to march up, even if things
Yes.
are compressing. So they're up to half a billion in revenue the last 12 months, and that's compared to in 2019 they were only at 100 million. So massive revenue growth in a few
Hmm.
years. And
Yeah.
but meanwhile the gross margins have sustained themselves, which is amazing.
Yeah, and they're growing. They're selling more than just scrubs now, and it's got that share of mind as like they still have the luxury of being the first to market there. So competitors are having a hard time breaking in.
All right,
You know,
let's see that balance sheet though. So we got 150 million ish in cash, 180 if you count whatever these short-term investments are.
yeah, the balance sheet's going to be okay because they just IPO'd, I'm sure.
That's not a given. The last few years, not a given at all.
Yeah, that's true.
No long-term debt though. Just have
Yeah.
some
So
leases, 17 million, so small. And then Total shares outstanding have slowly ticked up, but you said there's a lot of stock-based comp.
Yeah, I watched. Let me show you the or you can see it.
Or yeah, that's over
Look,
here.
wait. Go back. You gotta
Yeah,
see that.
sure.
You look at the. Okay, look how much was in 2021. 81 million. Isn't that
Oh, there
crazy?
it is. Yeah, okay. I was trying to find it. Yeah. So wow, 81 million in stock-based comp. That's when they went public. So
Yeah, and
people got their
so they
payouts.
did, but they're still doing 40. And I'm like, think about what if your stock went from 50 to 5, and your stock-based compensation pretty much, went from 80 to 4. Think about the difference in like dilution that's happening,
Yeah.
if you're keeping the value the same.
Yeah, if
And
you're ignoring the fact that the company is dropped so much,
yeah,
and you
and
just look at the number, oh, it's only, it's half from before, but I mean, it's not exactly, because you have to factor in the actual value
mhm.
now. So yeah, good point.
And then let me know whenever I'm sharing.
Okay, your
I'm gonna
screen's
go
up
through
now.
there. Okay, this is their Q2 2023 earnings presentation. I forget who it was. It must have been, I want to say it's Peter Lynch, but I don't remember exactly who it was. Like, you should discount, you should knock a stock for every colored picture in the annual report. Well, they got,
I wouldn't be
colored
surprised if that's something
pictures,
you said.
huh? But anyway, good. This is what I want to go. They have like their margin, like more colored pictures.
Yeah, it's like half of every slide is a picture.
And then it's like all of this. This is what's so crazy. It's like such a weird company in investing, because it's like all story, and then it's like,
All the stuff
oh,
here,
also financials. Yeah,
all the stuff we're programmed to avoid as value people, right?
yeah, yeah, all in the front. So they are spreading to the international markets. That's where a lot of the growth is going to come from.
Mm.
But the gross margin, you see, it's kind of
But
stabilized.
it's
Okay,
still
this
like
is
that's like Facebook margins though.
no,
Facebook
it's
Facebook
wild.
operates at
It's
70%
wild that
margin,
they're able to do that. Yeah. And
but
then they're
they're
direct to
software.
consumer. Yeah, and that's probably why they got such a huge IPO. I don't know. Yeah. But like you said, that was 2021. So this is 69%, let's say. And then this is what you're left with after they take out G&A, marketing, and selling, which, increasing selling.
What's
Okay, higher
selling expense
storage
versus
cost.
marketing?
Yeah.
Like what? Outbound sales or something? Like
Now maybe
commission?
selling is strictly commission. I don't know. That's
Yeah.
maybe it's storage. They say increased storage cost. Um,
So it's just cost of
so
goods
marketing,
sold
but
of
but
some
but but
sort?
this
Or
is what's
no.
great. Why do they have such a high G&A? Like, increase in G&A was primarily due to an increase in salary bonuses and stock-based compensation. And I'm like, ugh, that sounds.
Yeah,
But maybe
I
they're
think it
onto
was stock
something.
options vesting after they went public, had to be, because it
Oh
hit
yeah,
all these
yeah.
massive share prices. If I had to guess, but like you said, that they're continuing. So
Yeah, so it's just this crazy thing where I'm like,
is that
what if
dilution
they
set to stop? Any idea?
is there dilution to the stock? Is that
No, is it set to end at some point, or come down?
I don't know. Every time I look at them, I get kind of excited whenever they've gone down in the stock market, and then I look at them and I just get disgusted. I'm like, I can't continue on like that. But like, there's got to be a
Disgusting.
price where this makes sense though, as a value investment. Because like, what if it is like this kind of Amazon type, not like they're the next Amazon, but like they're just completely reinvest and grow revenue, grow the top line, and that these are kind of viewed as,
Are they a fad though? That could also be a thing. Are they a fad? I don't know how entrenched it is in medical, but obviously
that's what I
that,
was trying to ask those people. Every
yeah,
time I
do
every
they have
time
a
I
moat?
talk to somebody in the healthcare industry, I ask them about figs. Yeah, and it's
I mean, they obviously still have positive momentum,
oh no,
but
no,
yeah,
it's still the number one player as far
what
as like, at least in this region. Like, some of the quotes I've heard are like, oh no, you have to have figs, or else you're like, you're you're not, I don't know, to fit in
You're
almost,
not in the club.
you're not, and you're not cool.
It's
Yeah.
a cultish following, perhaps. But I guess if the quality is there, then it's good.
Yeah.
What about? Yeah, I think that would be my number one question. Is like, we've heard about some of these like big tech names that are pretending at least to address dilution. Are you seeing anything like with that? With
No, it seems like they have zero care for like traditional stock, like value, like investor
all with the
stuff.
growth story,
It's all about the brand and all about
the brand and
their
growth
new, their new things. And like that could wind up working. That's what I'm saying. There's gotta be, it's dropped from 50 to 5. Like there's gotta be a price where I could tell you they're not going to zero,
No,
So there's
sure.
got to be a price where this becomes like an investment, like a real value investment, even though it like has all these things that scream like,
So they're at
trap.
$1 billion market cap almost, or about 936, and that's compared to what would you say the revenue was? $500 million in revenue. The balance sheet we said was pretty good with 180 or so in cash and short-term investments and no long-term debt.
Mm-hmm. I think $2 to $3 maybe.
Because
I don't know if I'll ever see that.
Free
that's
cash
kind of
flow
like
from a free cash flow perspective, they're at, in the last 12 months it says 12 million, but that wouldn't include the 40 million in stock-based comp. So still technically negative if you combine those.
So just think about that: 12 million in free cash flow, but their stock-based comp is 40.
40, right? But at least they've had. Well, I don't want to say they've had positive free cash flow just because it doesn't count the dilution, but yeah, that is an interesting one. I see where you're getting at though. It's like it has like all the hype stock qualities to it, but then some like randomly amazing underlying things that you're like, oh,
Yeah,
that get your attention as a value guy. So it's like, yeah, I see where you're coming from, but
it's like well, I'll give you another example of one that has all the hype that I think is a really good underlying business is Peloton. Another thing I got talked into buying. But we don't.
Oh no.
Yeah.
When though? That's been a roller coaster.
Yeah. So, no, not the stock. I've not bought the stock. Bought the actual bike. Yeah. Even worse.
Confused. I'm like,
actually, no, it's
recently?
probably worse to buy the stock. No, I never bought Peloton stock.
I thought you meant like recently because it's the same kind of deal. It's got destroyed since 2021.
No. Yeah. No, there is no chance I'm buying that stock.
No, well, there's certainly a chance. Just not today.
Yeah, it was another one that I looked into after experiencing the Peloton and being like, watching how much, like we literally bought, you buy a $2,000 bike and then you pay $45 a month on top of that to use the bike that you paid $2,000 for. And I'm like, what the hell is this about? And anyway, yeah, they got the recurring revenue stream. They have their bike, their rowing machine, their treadmill, but anyway, once again, it's just the underlying financials are terrible. So
yeah, but so this was quite the mix here. We had, debt laden, we'll call it materials company with some potential strong upside. We have a clean balance sheet, luxury boat company.
Magic formula, yeah.
And then we have a high end, popular medical clothing brand with massive dilution.
Yeah.
that is quite the mix.
Yeah, well, that's I wanted to keep it.
No, that was fun.
Interesting, yeah.
I didn't expect such diversity in the companies, but that's what makes it fun because there's so many different companies out there, and it's fun to go through the exercise and you see the similarities, the differences, different lessons you can take from certain stocks. Because especially that Figs one is very unusual. Like because it has those strong qualities in addition to just some awful qualities. And, it gets your attention at least. And there is a price to pay for everything. That would be one to keep an eye on. If they can grow into their dilution, then maybe that works. Or if the dilution stops for some reason, though, we need some proof that they can do that. Yeah. So that's just a watch list one, right? You don't own figs at the moment.
No, I don't see. Like I said, it's got to get probably to $2 or something.
Yeah, you need a massive shift down or some fundamental boost of some sort.
Yeah.
Okay. Well, I guess any final thoughts then, Patrick? This was fun.
No, I enjoyed it. Sorry, I'm a little under the weather, but
yes, please feel better soon. And someone was mentioning that it looks like you're drinking straight NyQuil.
No, that's Guinness. But yeah, I'll probably.
No, it's not. We can't say that for YouTube. YouTube probably won't like that. It was apple juice.
It was okay. Yeah. Serious? They won't like that?
I don't know. Who knows?
Yeah.
They probably won't mind us talking about boats and scrubs. But
we can say it in this context. Warren Buffett owned Guinness, I think, at one point. Yeah, not the company, but I think he bought shares. Yeah.
Okay. All right. Yeah. You're just it's in
stock research.
It's a nod to him. So okay. Well, thanks again, Patrick. Everyone, thank you for stopping by. And be sure to go check out Patrick's channel if you haven't already. I'll link it in the description below. But definitely looking forward to having you on again, Patrick. And maybe you'll feel a little bit better next time. But otherwise, be sure to subscribe so you don't miss any future episodes. And that goes for these live shows or any of our midweek shows. And with that said, until next time, everyone, thank you.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.